Forget get-rich-quick schemes. We're here to talk about the time-tested principles that can turn even the smallest savings into a future of financial freedom. We all dream of a future where financial worries take a back seat, where opportunities abound, and where we have the freedom to pursue our passions. But the journey to building wealth can sometimes feel like navigating a complex maze, especially when you're just starting out. Tonight, I want to demystify that journey and share some fundamental principles that can empower anyone, regardless of their current financial standing, to begin building a solid foundation for long-term prosperity. Friends, fellow dreamers, ambitious souls. Tonight, I want to delve deeper into a concept that may seem simple on the surface, yet holds the profoundest power when it comes to building lasting wealth. Start early and be consistent. This isn't just a piece of financial advice. It's a fundamental principle that leverages the very fabric of time to work in your favor. Imagine planting a tiny seed today. If you nurture it consistently, providing it with the essentials it needs, what happens over time? It doesn't remain a tiny seed. It grows, it branches out, it potentially bears fruit, and even its offspring can continue that cycle of growth. Your money, when invested wisely and consistently from an early stage, behaves in a remarkably similar way, thanks to the incredible phenomenon we call compounding. Think about it. Life is a journey measured in time. Every day that passes is a day you can either choose to let your money sit idly or put it to work for your future. Starting early provides you with the most precious resource of all, time. Time is the fertile ground where the seeds of your investments can take deep root and flourish. The longer your money has the opportunity to grow, the more significant the impact of compounding becomes. It's like a snowball rolling down a hill. The earlier it starts, the more snow it gathers, and the larger and more powerful it becomes by the time it reaches the bottom. Even small, seemingly insignificant amounts invested early can transform into substantial wealth over the decades. Consider two individuals. Sarah starts investing $100 every month at the age of 25, and John starts investing $200 every month at the age of 40. Let's assume they both achieve an average annual return of 7%. By the time they both reach 65, who do you think will have accumulated more wealth? The answer might surprise you. Despite investing half the amount each month and for a shorter duration, John's total investment will be significantly less than Sarah's. However, because Sarah started 15 years earlier, her initial investments had a much longer runway to compound and grow exponentially. The early years, even with smaller contributions, are incredibly powerful because they lay the foundation for decades of compounded growth. Consistency is the unwavering commitment to this process. It's not about making a huge splash with a large investment one day and then forgetting about it. It's about the steady, rhythmic beat of regular contributions, no matter how small they may seem initially. Think of it like dripping water on a stone. A single drop might seem insignificant, but consistent dripping over time can eventually carve its way through even the hardest rock. Similarly, consistent investments, even modest ones, build momentum over time. They create a disciplined habit, reinforcing your commitment to your financial goals. It's about building a financial muscle through regular exercise. Each time you save and invest, you strengthen that muscle, making it easier to prioritize your financial future. Don't fall into the trap of thinking you need a large sum of money to start investing. The beauty of starting early is that you can begin with small, manageable amounts. Many investment platforms today allow you to start with as little as a few dollars. The key is to get started. Don't wait for the perfect moment or until you have a significant amount of money. The perfect moment is now, and the most important amount is the first amount you invest. Every dollar you invest today has the potential to multiply many times over in the years to come. Furthermore, starting early provides you with a valuable buffer against life's inevitable financial bumps in the road. The longer you've been investing, the more time your portfolio has to recover from market fluctuations. It allows you to ride out the short-term volatility and focus on the long-term growth potential. Think of it like a sturdy tree with deep roots. It can weather storms that might uproot a sapling. Early and consistent investing builds those deep financial roots, providing you with greater security and peace of mind. This isn't about depriving yourself in your youth. It's about making smart choices today that will unlock greater opportunities tomorrow. It's about understanding that the small sacrifices you make now can lead to significant gains in the future. It's about taking control of your financial destiny and laying the groundwork for a future where money works for you, rather than you constantly working for money. Embrace the power of time, commit to consistency, and take that first step today. Your future self will thank you for it. Friends, fellow architects of our own destinies, let's turn our attention to a principle that forms the bedrock of any sustainable wealth-building journey. Live below your means and save diligently. This isn't about embracing a life of scarcity or denying ourselves the joys and experiences that life offers. Instead, it's about cultivating a mindful relationship with our finances, understanding the flow of our resources, and consciously creating a surplus that can be channeled towards building a brighter future. Imagine a vessel meant to hold water. If the inflow is constantly matched or exceeded by the outflow, the vessel will never truly fill. Similarly, if our spending consistently equals or surpasses our income, we will remain in a state of financial stagnation, perpetually chasing our tails. Living below your means is the art of intentionally spending less than you earn. It's about making conscious choices about where your hard-earned money goes, prioritizing needs over fleeting wants, and resisting the societal pressures that often push us towards unnecessary consumption. This requires a clear understanding of your income and your expenses. It necessitates taking an honest look at where your money is currently going and identifying areas where you can make adjustments. This isn't about drastic overnight changes. It's about making small, sustainable shifts in your spending habits that accumulate over time. Perhaps it's brewing your own coffee instead of frequenting expensive cafes, packing your lunch instead of eating out daily, or finding free or lower-cost alternatives for entertainment. These seemingly minor adjustments can create significant savings over the course of weeks, months, and years. Saving diligently is the proactive act of setting aside a portion of your income consistently. It's about making saving a priority, not an afterthought. It's about viewing saving not as what's left over after spending, but as a fundamental part of your financial routine. Treat your savings like a non-negotiable bill you pay to your future self. Automate this process whenever possible. Set up recurring transfers from your checking account to your savings or investment accounts on payday. This removes the temptation to spend that money and ensures that saving happens consistently, even when life gets busy. The amount you save is less critical in the beginning than the establishment of the habit itself. Start with a percentage that feels comfortable, and as your income grows or your spending habits become more efficient, gradually increase the amount you save. The power of living below your means and saving diligently lies in the creation of a financial surplus. This surplus is the fuel that powers your wealth-building engine. It's the capital that you can then deploy into investments, allowing your money to work for you. Without this surplus, you remain financially tethered, with little opportunity for your wealth to grow beyond your direct labor. This principle isn't about hoarding money. It's about strategically allocating your resources to create future financial freedom and security. Furthermore, living below your means provides you with a crucial safety net. Life is unpredictable. Unexpected expenses, such as medical bills or job loss, can arise without warning. Having a healthy savings cushion provides you with a buffer to navigate these challenges without derailing your long-term financial goals or accumulating debt. This financial resilience reduces stress and provides a sense of security, allowing you to approach life's uncertainties with greater confidence. This principle also fosters a sense of empowerment and control over your financial life. When you are consciously managing your spending and actively saving, you are no longer a passive participant in your financial journey. You become the driver, making informed decisions that align with your values and your long-term aspirations. This sense of control can be incredibly motivating and can spill over into other areas of your life, fostering a greater sense of agency and self-efficacy. Living below your means and saving diligently isn't about restriction. It's about intentionality. It's about aligning your spending with your values and prioritizing what truly matters to you. It's about creating a life where your financial resources support your goals and aspirations, rather than hindering them. It's about building a solid foundation of financial well-being that will serve you and your loved ones for years to come. Embrace this principle, cultivate mindful spending habits, and make saving a consistent priority. This disciplined approach will unlock the power to build wealth and create the financial future you envision. Friends, fellow navigators of the financial seas, let's now chart a course into the realm of making our saved money work even harder for us. Understand basic investment principles. We've established the critical foundations of starting early and consistently, and the disciplined practice of living below our means and saving diligently. These are essential steps, but they are only part of the journey. To truly build wealth, we must learn how to deploy our saved capital effectively, allowing it to grow and compound over time. This requires a fundamental understanding of the world of investing. Imagine diligently saving grains for the winter. You could store them away safely, ensuring you have enough to survive. But what if you learned that you could plant some of those grains, and with the right care and conditions, they could multiply, yielding a much larger harvest in the future? Investing is akin to planting those seeds. It's about putting your saved money to work in assets that have the potential to grow over time, generating returns that can significantly accelerate your wealth-building journey. The first principle to grasp is that of different asset classes. Think of these as different categories of investments, each with its own characteristics in terms of risk and potential return. Stocks, also known as equities, represent ownership in publicly traded companies. When you buy a stock, you become a part owner of that company and can potentially profit from its growth and profitability. Historically, stocks have offered higher potential returns over the long term but also come with higher volatility, meaning their prices can fluctuate more significantly in the short term. Bonds, on the other hand, represent loans you make to governments or corporations. They typically offer lower potential returns than stocks but are generally considered less risky. Mutual funds are like baskets of investments, pooling money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. This diversification helps to reduce individual stock or bond risk. There are also other asset classes like real estate, which involves investing in property, and commodities, which include raw materials like oil and gold. Understanding the concept of risk and return is paramount. Generally, there's a direct relationship between the two. Higher potential returns often come with higher levels of risk. It's crucial to understand your own risk tolerance, your comfort level with potential losses, and to choose investments that align with that tolerance and your long-term financial goals. A younger investor with a longer time horizon might be comfortable taking on more risk in pursuit of higher potential returns, while someone closer to retirement might prioritize lower-risk investments to preserve capital. Diversification is a cornerstone of sound investment strategy. It's the principle of not putting all your eggs in one basket. By spreading your investments across different asset classes, industries, and geographies, you can reduce the impact of any single investment performing poorly. If one investment declines, others may perform well, helping to cushion your overall portfolio. Think of it like having multiple streams of income. If one dries up, you still have others to rely on. Another crucial concept is compounding, which we touched upon earlier. When it comes to investing, compounding works its magic on your returns as well. Not only do you earn returns on your initial investment, but you also earn returns on the accumulated returns over time. This snowball effect can significantly accelerate the growth of your wealth over the long run. The longer you invest and the more consistently you reinvest your earnings, the more powerful compounding becomes. Don't be intimidated by the world of investing. While it can seem complex at first, there are numerous resources available to help you learn and understand the basics. Start with educating yourself through books, online courses, and reputable financial websites. Consider seeking advice from a qualified financial advisor who can help you understand your options and create a personalized investment plan. The key is to take the first step, even if it's a small one. Many investment platforms offer user-friendly interfaces and allow you to start with relatively small amounts of money. Remember, investing is a long-term game. There will be market fluctuations and periods of volatility. It's crucial to stay focused on your long-term goals and avoid making impulsive decisions based on short-term market noise. Patience and a disciplined approach are essential for weathering market ups and downs and allowing your investments to grow over time. Understanding basic investment principles empowers you to take control of your financial future. It transforms your saved money from a static resource into a dynamic force working towards your long-term aspirations. It's about moving beyond simply saving and actively participating in the growth of your wealth. Embrace the learning process, take informed steps, and unlock the potential of your money to create a more secure and prosperous future. In closing, remember that building wealth as a beginner isn't about striking it rich overnight. It's about laying a solid foundation through consistent effort, mindful spending, and the intelligent deployment of your resources. By starting early and being consistent, you harness the incredible power of time and compounding. By living below your means and saving diligently, you create the essential fuel for your financial growth. And by understanding basic investment principles, you empower your savings to work harder for you, turning them into seeds of future prosperity. This journey requires patience, discipline, and a commitment to continuous learning. Embrace these principles, take action today, and you'll be well on your way to building the financial future you deserve. Thank you.